the spoiled brat theory to explain the Fed buying stocks. In this video, I'll share the research that's helping me make investment decisions right now. This is Andrew Stotz of Stotz Investment Research. Let's get started. So the first thing I'm going to go through is about how banks aren't lending, which means no money creation. I'll be talking about inflationary government spending, and then the fact that I think we aren't going to get any tapering from the Fed because they can't let rates rise. Let's first look at banking, but before we do that, we've got to go back in time to 2008, to the crisis. In September 2007, the Fed started cutting interest rates. They started panicking. Now, in America, there's something called Fannie Mae. Fannie Mae is a U.S.-sponsored enterprise, government-sponsored enterprise. It was founded in 1938 to expand the secondary mortgage market. Now, in most countries around the world, we do not have an organization like Fannie Mae that's buying secondary mortgages. In other words, a bank issues a mortgage to a customer. The bank holds it on their balance sheet in countries like Thailand because there is no place to sell it. Therefore, a bank would never give a 30-year fixed-rate mortgage because they know their cost of funds will change over time. But in America, they can, and basically banks sell their mortgages to Fannie Mae. Let's talk about the housing crisis. From October 2007 to August 2008, Fannie Mae's share price collapsed by 85%. In fact, eventually the government took Fannie Mae and Freddie Mac over. Now, S&P peaked in October 2007 at 1562. And what we can see is that by the 6th of August 2008, it was at 1298, which was down 17%. By the 11th, it was down at 899, which was down 42% from October. And finally, by March of 2009, it was at 683, down 56% from October 2007. That's the worst bear market since the Great Depression. That was 2007-2008. Congress took action, and they passed the $700 billion Troubled Asset Relief Program. That lent about $115 billion to banks. In fact, it wasn't really a loan. They were preferred shares that the government bought. And then in 2009, Congress passed an economic stimulus package for $787 billion. Now, normally the Fed pushes money into the economy through the banks. The Fed lowers interest rates and the banks follow. This would increase lending. This expands the money supply. But in 2008, and especially now, the banks did not respond. I'm going to show you a chart, a table here that's just kind of shocking what happened. Instead, the U.S. banks built up cash. You can see in the 2008 crisis, in August of 2008, the banks had 2.8% of their total assets in cash. But by the time they got to August 2014, it was 19.7. Look at the 2020 crash or crisis, and you can see that banks had 9.9. So they had a lot more cash to start off with, but they still doubled that almost up to 18%. Basically, the banks are hoarding cash, and they have been throughout this whole crisis. That's part of the reason why the Fed stepped in. Now, let's look at loan-to-deposit ratio. Loan-to-deposit ratio helps us to understand if a bank receives 100 in deposits and it lends out 100 in deposits, then its loan-to-deposit ratio would be 100%. But if a bank received 100 in deposits and they lent out 60, that 40 is not lent out, and therefore that 40 is basically not part of the money supply. In fact, it's used either to hold it as cash or to buy government treasuries. In 2008, the banks were almost at 100% loan-to-deposit, but by 2020, they were getting down, and now they're down to 60. So banks have held back their lending into the economy, and that's part of the reason why no matter what the Fed has been doing through the banks, it's not causing a stimulus effect, particularly to monetary policy through the banks. Now, let's just look at cash and government securities on the balance sheet of banks. After the 2008 crisis, the Fed cashed up the banks, and the banks then lent to the Treasury. You can see that the red line, cash, was up by $2.6 trillion. That's 869% from when it was just held at a tiny little level for many, many years. Then government security holdings were up about 68%, up by about $786 billion. Now that's the cash and government securities. That's like the most safest and liquid part of the balance sheet. Now, let's look at the loans in the balance sheet. And here we can see the largest loans are real estate loans, then business loans, and then consumer loans. Business loans were up $201 billion, or 13%, from the time of the crisis, prior to the crisis, down, and then after the crisis. Real estates were about flat, and consumer loans were up a bit. Now let's look what the balance sheet looked like. This table shows us cash, government securities, business loans, real estate, and consumer, and it basically shows that almost all the growth in the balance sheet of the banks went into cash and government securities. In fact, if you add up those two, you have $3.4 trillion that didn't go to the private sector. And this causes what we call crowding out. So the private sector was not getting that much funding through the banks. Now, after the 2020 crisis, the banks got cashed up again. And you can see it in the red line there that cash went up by 2.2 or 2.1 trillion dollars. That's up 119%. Government securities were up 1.176 trillion. That's up 39%. Now, let's look at the business loans. What do we find? Barely any money was lent to the private sector since the 2020 crisis. We can see 115 to businesses, 115 billion, 42 billion to real estate, and down 23 billion to consumers. And that is basically when we started to see the 2020 crisis. Now let's put this into a table format again so we can compare side by side. We can see that $3.3 trillion in this case, that's adding up cash and government securities, didn't go to the private sector. Again, this is crowding out of the private sector. The banks aren't lending, hence they aren't creating money, because remember, when the banks loan, that is the creation of money. So what are the key points? Well, first of all, action taken in 2008 led to crowding out of the private sector lending. After 2020, like 2008, barely any money was lent out to the private sector. Banks aren't lending, hence they aren't creating money, because money through the banking system happens when the banks lend. So no matter how low the Fed lowers its rates, the banks aren't lending. Hence, there's no inflationary pressures there yet. That may start. Now, inflationary pressures are coming from other points. So let's look at this. Here we can see government has sent stimulus checks to people to spend, of course. In 2020, income security rose to $1.3 trillion from $500 billion. So a big spend. Also, unemployment compensation and other income security rose by more than $700 billion. Now, government stimulus creates additional demand, but the people receiving the stimulus checks weren't really creating any additional supply because many of them were out of work, which makes this inflationary. Strong demand, less supply. That is a deflationary or inflationary move. Now, finally, let's just look at the balance sheet of the Fed right now. The balance sheet of the Fed shows that as of September 2001, U.S. Treasuries are about $5.4 trillion on the Fed's balance sheet. That means they're buying U.S. Treasury or government bonds, and they're doing that through the banks. And then mortgage-backed securities of about 2.4. That jumped from 0.1 in 2019. And so you can see about $8 trillion on the balance sheet of the Fed. So what's the key points here? Government stimulus checks create additional demand without recipients contributing to increased production. This is inflationary. And banks are sitting happy with nearly 40% of their balance sheet in cash and risk-free assets. The Fed has ended up funding the government through the banks. Stimulus checks and excess government spending is inflationary. So now let's get into the final topic of no tapering since the Fed can't let rates rise. First of all, we have to look, if I look at debt levels in the U.S. economy back to 1952, they are out of control. The federal government after the 2008 crisis just went nuts. We can see a rise in business borrowings also, which was pretty massive, but not out of control like government. And we can see there was some correction of households, and then that started to rise again. If we want to put this into as a percent of GDP, we can see that government debt as a percent of GDP now is up above 120%. And we can see that for the households and businesses, yes, it's up, but I would say it's not totally out of control. Now, the massive U.S. government debt is another reason that the Fed doesn't want to taper and raise rates. Because ultimately, taper means what? That they're not buying as much bonds in the market anymore. That means they're not putting money into the market. They're extracting money if they're really tapering. And if they're really tapering and they're extracting money, it means interest rates are going to go up. But I just want you to look at this particular area. I'm just going to get out my pen here. And this is the key right here. That green line is showing an interest rate that I calculated about 1.8% that the U.S. government is paying on its 30 trillion in debt, which we can see 30 trillion right there. And that means that that's an interest cost of about $522 billion, right? I think I mean billion on that. Let's see. Not sure. But yeah, there it is. So in expense, about 500 billion, I think. So basically what we can see is this is 15% of government spending. Now, what would happen if interest rates were to rise? If interest rates were to go to 3.6, then this cost would go up to almost $1 trillion. That would be about 31% of the U.S. government budget. Politicians would stop this from happening. Therefore, the Fed is not tapering means that interest rates have got to stay low, or else the U.S. government is dead. And that $1 trillion in interest costs is also me assuming that the 30 trillion in debt isn't going to rise, and I suspect it is. And that brings us finally to the spoiled brat theory, the bigger reason that the Fed won't taper. What do I mean by this? Companies and stock market investors are the biggest brats these days. Workers and the small guy are left with the scraps. So what does the spoiled brat theory mean? We all have seen that spoiled brat. He cries and screams if he doesn't get what he wants. In the old days, Dad used to say, "Quit your crying or I'll give you something to cry about." But not anymore. Nowadays, many people have been conditioned into thinking the government's role is to prevent pain. But without pain, the market is not free and the market cannot adjust. So the spoiled brat wants candy and the U.S. government will continue to give it. If the Fed started to taper and the market started reacting negatively, then the Fed would reverse course. That's my prediction. And if the candy's not enough, the Fed could always support the market through special purpose vehicles like they did previously, and they did that through BlackRock and other instruments that they created with the Treasury to buy bonds. And they didn't buy that much bonds, but they signaled they would buy any bond that they needed to. And that kept the market from collapsing in the bond market. They can do the same in the stock market. And that's basically my prediction is if they start to taper, we're going to get a taper tantrum. And then what's going to happen is the Fed's going to come in and buy. So what are the key points? U.S. government debt is massive, so politicians want to keep rates low to reduce the interest burden, taking away from other government spending. I mean, the government's going to go crazy. Politicians are going to go crazy if there's no money left to spend on the type of things they want to spend on. Now, Americans have been spoiled for so long that the Fed can't stop giving away this candy. The Fed will do anything to keep the spoiled brat from having a taper tantrum. The bottom line, inflation is likely to continue, and the Fed is unlikely to raise rates aggressively to stop it. That's my spoiled brat theory. Tell me your thoughts.